Welcome back to another episode. In this video, we will go through our Heiken-Ashi trading strategy. Heiken-Ashi candlesticks are excellent because they smoothen price movement. Heiken-Ashi charting eliminates a lot of the noise seen in conventional Japanese candlesticks, which makes deciding when to enter and leave a trade a lot easier. I will showcase some very good practical examples in order for you to understand the strength of this trading technique. With the vast number of candlestick patterns available, it can be overwhelming to decide which one is the right signal to enter a trade. Have you ever experienced getting out of a trade prematurely, only to watch it continue in your desired direction? It can be frustrating to miss out on potential gains by exiting a trade too early. Trading can be a complex process with many factors to consider. If you spend too much time analyzing your entry rules, you may miss valuable trading opportunities. Similarly, exiting a trade too early can negatively impact your overall profitability. One solution to simplify the process is to use Heiken-Ashi bars to make precise decisions about when to enter and exit trades without the need for complicated analysis. In this video, I will present a strategy using the Heiken-Ashi technique to simplify the process of determining when to enter or exit a trade. I have simplified them into three main types of price action patterns, making it easier to analyze and reducing the noise while trading. The first type of Heiken-Ashi pattern is the bullish bar. These bars are characterized by the presence of a wick at the top and the absence of a wick at the bottom. As long as the bar is an upward trend with no wick at the bottom, it is considered a bullish signal. The second pattern is the bearish Heiken-Ashi bar. These bars are the opposite of bullish bars. They have a wick at the bottom, but no wick at the top. As long as the bar is a downward trend with no wick at the top, it is considered a bearish signal. The third pattern is the indecision Heiken-Ashi bar. To simplify the Heiken-Ashi patterns, all bars that have wicks at both the top and bottom are categorized as indecision bars. Regardless of the color of the bar, if there are wicks on both sides, it is considered an indecision Heiken-Ashi bar. Here are some rules for initiating a long trade. Criteria 1. The higher time frame must be in an uptrend. This means that the high time frame must be making higher highs and higher lows. For example, if you're trading the 1 hour chart, the higher time frame would be the 4 hour chart. And if you're trading the 4 hour chart, the higher time frame would be the daily chart. It is generally not recommended to trade on a time frame lower than 1 hour, as the spread and commissions can eat away at your profit margin. Criteria 2. The 10 exponential moving average must be above the 30 exponential moving average. The EMAE is a technical indicator that helps traders identify trends by smoothing out price fluctuations. The 10 EMAE and 30 EMAE are used to determine the momentum of the trend. Criteria 3. Both criteria 1 and 2 must be met on the time frame you are trading on. Once all three criteria are in place, look to go long. When the price bounces off either of the exponential moving averages and the first bullish Heiken-Ashi is formed at a higher low, place a stop loss below the low of the current swing low. In order to enter a short trade, the criteria is simply the opposite that of a long trade. Criteria number 1 is that the higher time frame, such as the weekly or monthly chart, must be in a downtrend. This can be identified by looking for patterns where the stock's price is forming lower highs and lower lows. Criteria number 2 is that the 10-day exponential moving average EMAE must be below the 30-day EMAE. When the 10-day EMAE is below the 30-day EMAE, it can indicate that the stock is in a bearish trend. Criteria number 3 is that the time frame you're trading on, such as a 5-minute chart, must also meet criteria 1 and 2. Once you have identified that all three criteria are met, you can look to enter a short trade by selling shares when the stock's price bounces off either of the exponential moving averages and the first bearish Heiken-Ashi candlestick pattern is formed at a lower high. Now, here's how to exit a trade using Heiken-Ashi bars. For long trades, you would want to exit the trade when a bearish Heiken-Ashi bar is formed, as this can indicate that the trend is reversing. Similarly, for short trades, you would want to exit the trade when a bullish Heiken-Ashi bar is formed. It's important to keep in mind that Heiken-Ashi bars may not always be 100% accurate, and you may sometimes get faked out of a trade where a bearish Heiken-Ashi bar forms, but the next bar becomes bullish. This is normal, and it's important to focus on your overall profitability over a series of trades.